Paying points on a mortgage. How does that affect your interest rate? What is the cost? And how do you figure out if you should do it? And how much you should pay? Frankly, it's understandably confusing. There are variables beyond what a lender or a borrower can control. So for example, there was a time when there was no par rates available. A par rate is essentially a no-point rate. There's typically three options: a rate that you have to pay extra for by way of points or partial point, a rate that's actually over par, meaning there's extra premium we as a lender can give back to the borrower in the form of a lender credit, and then the par rate, which would be no extra point or points, but also no lender credit. There was a time not long ago when you really had no choice but to pay at least a partial point. It's complicated, but these investors that make money off the monthly interest you pay were very concerned that mortgage customers would pay off their loans quickly through refinancing with an expected drop in interest rates. So they were looking at the market environment and saying, we better get some revenue up front because we may not be getting the interest payments for very long. So a full point is 1% of the loan amount. So for example, on a loan of $400,000, that's a one-time $4,000 fee to pay a point. A half point is $2,000, and say 2 points would be $8,000. You get the picture. It's all about the math, but the calculation changes with every rate. The number I focus on is your break-even point. For example, in this scenario, let's say the par rate is 7%. But if you pay 1 point, the rate drops to 6.625%. But beware, that drop in rate of 0.375 for 1 point is not by any means a hard and fast rule. Could be more, could be less. But in this scenario, the payment at the 6.625% is about $99 a month less. That helps, right? But if you paid a one-time fee of $4,000 to save the $99 a month, it's going to take about 40 payments. So 30 years and 4 months later, before you've saved back that $4,000 fee you spent up front. In other words, that's your break-even point. Now, if it's a 30-year mortgage that you see to the very end and never sell or refinance, that means you save that $99 a month for another 320 months beyond the break-even point. That's over $31,000. But realistically and statistically, most loans don't last nearly that long. What if in 12 months the rates drop to 4.75%? Well, most definitely makes sense for you to refinance, and you should. But you've only made back at that point $1,200 of that $4,000 investment you made up front with that point. My job as a lender is to show you in easy math the numbers, and then we talk about the probabilities and time frames of selling or refinancing and make an educated decision at that point based on your particulars. Nobody can predict the future, both your own and the markets. You just do the best you can, and my advice is typically not to go too extreme in any direction. You want a lender that's paying attention and cares. For example, I had a couple recently that had it in their mind a for sure retirement date in 4.5 years. And it was based on the husband's job. It was pretty clear at that point they were going to be selling their house and paying cash for their last home, essentially downsizing to a home in Arizona at that point. They were buying a home in Michigan for the last 3.5 years before that point and wanted to buy down the rate. When I put numbers to what they wanted to do their break even was over 5 years. And again, that's just breaking even. They were 100% sure they'd be gone before then, so it simply made no sense to buy the rate down in their circumstance. I hope this helps. Every situation is different. I'm Dave Saylor with Highlands Mortgage. Please like and subscribe and comment or reach out with any questions at all. Thanks.